Today is Friday 19th of December, 8:20 a.m. in the morning. It's pre-market open, so look at last night's close, May 2015 contract, and we'll look at the monthly one we've got in front of us, monthly bar chart. And you can see here this green candle here, that's December 1 before moment, and it's broken through, closed last night, dead on just above the 140. Obviously on the monthly chart, we're still in this downward channel of falling prices the last 2 years, but we are now seeing a third green candle. This was last seen back in 2007 and 2010, and then we had 7 candles preceding that. So let's go down the weekly chart, and you can see here quite clearly marked with 140, broke up, and really interesting on this chart here, the 60 monthly moving average here. You can see how it held this rise at the beginning of 2014 and how prices have tested to the T at 147.48 yesterday and fallen back. The key to this now obviously is if we can get a weekly close tonight above this 140 level. If we can, then it's very bullish, and obviously I'll show you the reason why as we go down further into the charts, especially if we could then come up and break above this 60 weekly moving average, and it would break this 2-year downwards trend. So we just pop down into the daily, and you see my plan here that we had from the 27th of October. My wave 5 count was 146. So I'll just go down on the daily and show you where that's happened, and you can see here yesterday we hit 146, 147. In my report last week I did call this move up here, foxed me a bit when we just got above the 143 here, but obviously there was still another part to come, so we sort of had an A, B, C upwards move into the wave 5, but that's completed nicely, this channel. The move has been textbook since the beginning of October, and it shows the power of this Elliott wave when you get it right with the moving averages, and you can get a nice move. You know, we've seen now, a good size move. It's come to fruition. We've 1 tick, 2 tick, 3, 4, 5. We've ticked to the T. They've come just right. Didn't take out the high number wave 3 last week, and everything was good. So just right to close the year on and obviously now we can look for a longer term situation, and that's what I'm trying to do here, to sum up on a yearly basis. And this is the only way I could do it, I'd move me across here. It was a hand drawn chart of the last back to 2005, and also projecting through to 2020. Along the bottom here, obviously yearly price is on the right of the scale here. Every little square I've got down to 6 months. So if we start at the bottom here in 2005, we were £70 a tonne. Basically had a big rally up here, and we hit just over £200 a tonne in 207, 208. Now what I'm trying to get here is some cycle analysis, so we can try and put a study forward for the next 5 years. You're probably going to say, well, that's absolutely ridiculous, how can you do that? But cycles are, the principle is that it's like predicting how the tides go, or how the moon, the full moon or whatever, and what you try and do is trying to find a cycle of repetition. And commodity markets, basically it's the price that causes the cycle, because obviously if you have high prices, then obviously the farmers drill more, and then what happens, there's an oversupply and prices fall. Similarly in the US, there's a connection between amount of corn grown, maize, against wheat, and if the price of maize goes up, there's more grown, and vice versa. So I'm trying to find some connection to give us some sort of edge where we can keep an eye on a long-term plan, and basically I've come up with this connection in this count. And basically what you do is take the lows and the highs, and I've come up with a pattern here that we're seeing 8 6-month sections, and then a 5, and then it goes to 9. And if you look along the top between the highs, you've got a 9, 5, and basically then you're looking for a 5 or a 9 to follow. So then you can start to put in when you could next see a top or a low within the market. Now the interesting thing is that I've split the months up. Obviously you've got the first 6 months year, so the last 6 months are the harvest months, and the highs and the lows are always coming in the last 6 months of the year. So that's one thing interesting to see. I've also put an Elliott Wave count on here. You can see that this started from back in 2005. We've had a 1, 2 in 2008, then we had another double bottom in 2010, a 3, a 4, 5, and we've now seen an A, B, C correction wave, which was around here. The A, B and C was around the 170 level. So basically what we're starting is a new trend. This lasted nearly 9 years, so we're starting a new 9-year cycle. And if we can take the principle of that it's going to follow the same as the last 9 years, we're then looking for a high to come in 5-6 months portion time. So basically we could see a high back up to £220 a tonne. Now this would be in 2015. So that would be from September to November, the end part of next year. We could see a high back up to £220 a tonne. You know, that's a big call, but let's look at it and just see how we can get. If we go for the 9-month cycle, then we won't see a high until 2017, the harvest section. Now on the reverse side of that, we've got a 5 comes in not until 2016 harvest section, so that's 2.5 years time. So basically we are looking for a high in the market in 2.5 years, or a low. We don't know that part at the moment, but I'll show you how that comes in 2015. Or we skip that and then the high doesn't come until 2017. So basically what we're looking at the moment is we've had a big move up over the last 3 months. So you could say that we're in a wave 1 count already, right? Okay, so what we can now plan out and say is a wave 1 should be very aggressive and the prices should continue. So basically we're looking back the same as what happened in 2005 up to 2006, and that, if we then we'll go back and have a look at the weekly chart, shows that we could be on the edge of a very, very big substantial cycle move, which would give us the wave 1. So we could be we could be on the edge of a really big aggressive move in wheat prices. Now, so what that gives you, it gives you the plan. Now you can then monitor that during January, February, March, April, May as we get through the harvest. There's not a wave 1, and it's going to be that unfortunately we're going back down to test a low, and this low will be in harvest 2016. So if we fail during this first half of the month to maintain 140, then it's more likely that we've still got a correction phase to come, and we're going back down in a sideways move for the next 2 years, and we could see lower prices going to a low down to hit 2010 of £110 a tonne. Now that would be in 2016. So basically, on the principle here, what I'm seeing at the moment is we've got a wave 1, and we've got potential of a really aggressive move that should see a peak in the market in the end part of 2015. If this wave 1 is a slower burner, then we won't see the high until 2017. So basically that's the plan. So if we then put on our weekly, come back our weekly chart, I'll just move myself down here, you can see how it starts to come together. That you can see back in 2000, I haven't got the 2005, but I'll have to show, I'll get that back. But you can see the rise here. This is the one in 2010. You can see when the market broke through the 6-day moving average here, came down, and you can see that we had this aggressive move up that lasted right through to 2011. And so what my trigger will be is that if we can take out and close a weekly close above this 60-day moving average, then we could see prices moving up for the next 2 years. If we just get on the monthly chart here, so this would follow in here. So this is the rise here. This was 2007 when we had the big rise up here. You can see that 1, 2, 3. We're now in this third candle, and then 5, 6, 7. So there's another 3 really aggressive candles to come. Here, look, 2010, 1, 2, 3, and then we had 5, 6, 7, 8, 9. Same again here. So if we can hold this candle till at the end of the month to close on a green candle, and we break this trend line here with a close, I think we've got a really aggressive market to come, with prices exploding over the next sort of 12 to 15 months. But obviously this is all put out if we fail to hold this 140. Now you can see that on this long-term chart here, that you can see this 140 is key to it's like cuts the whole chart in half, and a break above it signals that we're away. So basically, sorry to be so complicated, it's sort of planning in coming together, but I'm trying to give a sort of long-term perspective, and I'm feeling that if the key to it is the 60 weekly moving average, this blue line here on the chart, and if we can break through that, then I think we are on for my plan here, that we could see really high prices over the next 2.5 years for wheat. Obviously, if the first half of the year, if 140 doesn't hold, then that kicks the wave one theory out, and we're going to look for for the next 2.5 years, a sideways market with a low coming in 2016. So that's it really. So we can keep an eye on it. What we'll do is over the next year have this chart here that we just keep jogging along. We can add to it. It's like a roadmap if things fail, but it gives us some idea of where we're going, and then as we progress we can sort of get a long-term cycle going right through to 2020, and I hope that'll be useful. And just finally we'll look at the rate market, and you can see here that we've broken out of this triangle I was watching. 336 is the key. 6-day moving average moving up nicely now. Target from the triangle is up here at 365, and I see no reason why we shouldn't have a test of that. Thanks for watching, and I'll put an update this time next week, and a Happy New Year and a Merry Christmas.